If you are watching the show and you want winners right now, that means playing the trend, not the counter trend. On a day like today, you actually get some buying opportunities in the big cyclicals that have been cleaning up lately. Remember, the industrials have been roaring so much, in part because there's just so few of them. So they have tremendous scarcity value, which is why you have to pounce anytime you do get a buying opportunity. Let me give you some examples of what attracts me to them on a day like today. Well, we're going to start with the hottest of the hot. I mean, it is amazing this is the hottest of the hot, but it's farm equipment stocks, which we've suffered through for years. There are really only a handful of these left. There used to be a lot of them. So the best-of-breed names have been roaring in anticipation of a booming farm economy. Deere's the most obvious example. Here's a fabulous company with a long history of missing estimates. That's right, you heard me, or giving you a disappointing forecast. But with agricultural commodity prices roaring, Deere's last few quarters have been excellent, and management keeps raising guidance. Still, the stock of Deere is up 38% this year and is now selling for 23 times earnings. That means it's trading like a secular growth stock, like a Facebook. No, it's actually more expensive than Facebook. Not a boom and bust cyclical, which tend not to be that expensive. Now, can we really justify that? Absolutely. Because there's a scarcity of farm equipment names. AGCO, remember Martin Reichenhagen? AGCO is really the only publicly traded rival here. And Deere's been aggressively buying back its own stock for years. They've shrunk the share count by 25% over the past decade. AGCO's been doing the same thing. As a result, you've got a genuine stock shortage in the farm equipment space. You understand that? There's fewer shares to buy, and there's not that many companies in the space. Now, you see the exact same thing playing out in the railroads.
All aboard!
Which had some wild action today because one of the last independent American rails and one of our favorites, Kansas City Southern, is being acquired by Canadian Pacific. That leaves us with just Norfolk Southern, CSX, and Union Pacific, the latter of which we own for ActionAlertsPlus.com. Now, I think all three of these stocks are now worth buying. Right. Well, I actually liked them for a long time. But the most enticing is Union Pacific, which is kind of ridiculous. The stock really got crushed today. People are worried because Canadian Pacific's their West Coast competitor, but I don't think this merger is going to do all that much damage. What really matters is that another player's been taken out, creating more scarcity value, which makes Union Pacific the buy, not the sell. How about engines? That's another classic industrial group. There's really just two left, Caterpillar and Cummins, both of which, again, have been voracious buyers of their own stock. Think scarcity. Caterpillar shrunk its share count by 15% over the last decade. Cummins by 25%. 25%. In retrospect, those were prescient buys, right? What if you want to rent a machine rather than buy one? Well, then you've got United Rentals, another one that's been aggressively buying back stock. They've shrunk the share count by 19% in the last 10 years. Once again, scarcity value is working for you here. Now, I could perform this exercise for nearly every industrial, and you would see the same dynamic. Throw in the fact that many of these companies are components in the S&P 500, so they attract lots of automatic buying from index funds, and you get another source of endless demand. As long as the rotation continues, I think they do have more room to run, and today's the breather, maybe tomorrow, where you can finally get into some of these stocks. That's it. I don't want to totally dismiss the possibility the rotation has run its course. Today's movement in tech was very powerful. But I worry that the moment we get another whiff of inflation, this counter-trend rally will quickly fade. And when it fades, we'll find out that there's way too much stock for sale in the cohorts that aren't working or that have been the counter-trend like today. The growth stocks are the opposite of cyclicals. We have more shares than we know what to do with.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.